Hi everyone, welcome to the First Time Homebuyers presentation. This is me. My name is Catherine. I've been a mortgage broker since 1999, and what my job is to make sure that you are comfortable and confident with the whole process of purchasing a home. My job is also to make sure that you not only get the best rates that are going out there from all of the different lenders and all of the different banks, but also to make sure that you're put into a mortgage product that's going to suit your specific needs. My office is located at 9 Franklin Street in Waterdown. That being said, I can put your mortgage financing in place no matter where you're purchasing. Anywhere in Canada, I can place your mortgage. With you watching this presentation, either you're maybe living at home with your folks still, or maybe you're renting an apartment or renting a home right now, and you're deciding, well, should I continue to rent or should I buy? Well, one of the things that I look at is how much you're paying in rent right now, because if things are tight right now with how much you're paying in rent, then we want to make sure that your mortgage payment is not going to exceed what you're currently paying in rent. So that's one thing that I'll look at. Also, I'm going to send you a rent versus buying calculator so that you can take a look at the numbers and play around with that yourself. Do I qualify? Well, one of the main things that is looked at is income. So if you've just started a job, then and your job still has you on probation for say 3 months, you do need to wait until that job probationary period has been completed and you are now a full-time employee. So as long as you're a full-time employee, then income is looked at in a few different ways. If you're a salaried employee, then it would be the salaried income that I would be using. If you are an hourly employee, then it would be the number of hours that you work per week. So sometimes it's 37 and a half, sometimes it's 40, sometimes it's 42 or 44. I would look at that times the number of hours that, times your hourly rate of pay. And if you do get any overtime income or any bonus income, then you have to have been receiving that for a minimum of 2 years. And then I would use a 2-year average of your income. If you're a 100% commissioned employee, I need a 2-year average. If you are a self-employed person, I need you to have been self-employed for 2 years. If you're base plus commission, well then again, it would more than likely be a 2-year average, or I would just be looking at the salaried income. So when it comes to income, there's quite a few questions that I ask, but basically we're going to get proof of your income to make sure that there's no hiccups along the way. Credit. Credit is the other really important thing to be able to get qualified for mortgage financing. What we do is during the pre-approval process, I pull your credit bureau with Equifax, and I'd be more than happy to talk to you in detail about your credit bureau and your credit score. So your credit score does have to be above 600 to 620 to 630, somewhere in there, and it varies depending on lenders. Ideally, we'd like to see that you don't have any collections, and we ideally would like to see that you pay your bills on time and consistently. Now, that being said, there's a lot of people out there that have had trouble with their credit at one time or another. It's great to get fully pre-approved so that we can take a look at what your credit situation is and make sure that that's not going to be any kind of a stumbling block for you. And I'll then be able to also tell you how you can correct any potential credit issues that you may have. So when it comes to credit, not only are we looking to make sure that you're paying your bills on time consistently and that you don't have any collections, but we're also making sure that the amount of liabilities that you have, so the debt that you owe, that is taken into consideration for the qualifying process. Cosigner. Well, a cosigner would be required if there are issues around the income or around the credit. And I could give all kinds of different examples as to, what that would mean. But basically what a cosigner is it's somebody who just strengthens your deal. So let's say your ratios, which we're going to get into in a minute, are a little bit high for the price range that you want to purchase in. Then we'd see whether a family member could cosign. And when it comes to cosigning, I basically would do a full application on that person as well, add them into your mortgage application, and make sure that they qualify along with you. Now, cosigner does not have to stay on the mortgage for the entire term. Once you qualify for the mortgage on your own, we can remove the cosigner. There are 2 ratios that are looked at for mortgage financing. The first one is the gross debt service ratio. And so what the gross debt service ratio is it's your mortgage payment and your property tax and your heat. And if it is a condo, then 50% of the condo fees divided by your income or divided by the household income, so the people who are going to be on the mortgage financing. And so we don't want to see your gross debt service ratio be any higher than about 35 to 39%. And the reason why there's a difference between the 35 and 39 is that is depending on your credit score. What that means is it means that you're going to be financially comfortable with those mortgage payments as long as your gross debt service ratio is within that guideline. And then your total debt service ratio is everything that I just said. So your mortgage payment, your property tax, your heat, and 50% of the condo fees, and as well as any other expenses that you're carrying. So if you have a car loan or you have a car lease or you have an unsecured line of credit or you have credit cards that are not paid off on a monthly basis, then the balances and the payments are included in your total debt service ratio. So for example, let's say you have a credit card that you carry a balance of $10,000 on. I would look at 3% of that $10,000 balance, so $300, and add that in to your total debt service ratio. So we don't want to see your TDSR any higher than about 42 to 44%. And I'm going to be able to go over all that with you specifically. Perks for first-time home buyers. Well, the perks for first-time home buyers are that there is a credit that the government has for $750. Now, that is one that a lot of people really don't qualify for, but when it comes to the end of the year and you're doing your taxes, then it's worth it to mention to the person that does your taxes, or if you do them yourself, it's worth it to check to see whether or not you qualify for the $750 tax credit. The other thing is that if you have RRSPs, then as a first-time home buyer, you're able to take $25,000 out of your RSPs. So if you're a couple, you can take a total of $50,000 out of your RSPs, so $25,000 each, and you can use that money for down payment, and you don't have any tax implications on taking that RSP money out. You have 15 years to pay yourself back, so basically you can take the amount and you can divide it into 15 and pay yourself back 1/15 each year, or you can pay back any amount at any time. The other perk is the land transfer tax. So if you're a first-time home buyer, you are exempt from the first $2,000 worth of land transfer tax. Now, let's say one of you so you're buying two people, and one person has owned previously, then there still is a savings. It's just not the full $2,000. It would be approximately $1,000 savings for land transfer tax. Down payment. How much do I need to put as a down payment? Well, you can buy a house with no money down. However, there's only a couple of lenders that are offering the 0% down, and they don't call it 0% down anymore. It's now called a cash back mortgage. So if you don't have down payment, then you can possibly get a cash back mortgage. To get that, you do need to have a very high credit score, and it has to be a pretty strong application. So if you can avoid doing the 100% financing, it is best to avoid it, only because your interest rate is going to be significantly higher. The 0% down is basically the 5-year posted rate is what the rate is. So if you can put 5% down or more, then you're better off with not having to have these high rates, because the rates are significantly lower when you have a down payment. However, whether you're putting 0% down or any amount down, you do have to show that you've got a minimum of 1.5% of your purchase price for your closing costs. We'll get into that in a minute. Let's say you're putting 5% down, which really that is the norm for a first-time home buyer. Then you would be able to get the best rates that are going out of all the banks and all the lenders out there. Now, anything less than 20% down, so if you're putting 5, 10, 15%, or anything in between, then the mortgage has to be insured through Canada Mortgage and Housing Corporation, through which is also called CMHC, through Canada Guarantee, through Genworth Financial. Those are the 3 insurers in Canada. And the more money you put down, the less the insurance premium. Now, that insurance premium is different than, your house being insured for if, it was broken into, as an example. That insurance premium is for the lender. And it's basically if you weren't able to make your mortgage payments and the bank had to take your mortgage over as an absolute worst case scenario, then the bank would not be out the money because they've insured your mortgage with one of these three insurers. If you're putting 20% down, and you can do that from your own funds or from or from gifted funds, like let's say somebody from the family gives you some money for the down payment, then that mortgage does not need to be insured, and therefore there's no insurance premium being added on to your mortgage. And one more thing I have to say about this insurance premium, it's not extra money that you have to come up with. It's a figure that is added on to the mortgage. So basically, for a first-time home buyer, if you're putting anything less than 20% down, the amortization has to be 25 years. If you're putting 20% down, the amortization can be 30 years, and there are some lenders that will still amortize the mortgage over 35 years. So let's say you are putting 5% down and we're amortizing it over 25 years, and then let's say a year into the mortgage, you come into an inheritance and you're able to put 20% down on your mortgage. That will automatically lower your amortization, meaning that you'll have a lot fewer years to pay that mortgage off. Term. So with mortgages, there are 1-year terms. Actually, there's even 6-month terms. Basically, there's up to 10-year term mortgages. The most popular term is a 5-year term, and then there are fixed rates and there are variable rates. Sometimes people think, well, with a variable rate mortgage, there isn't a term, but there is. There are 3-year term variable rates and 5-year term variable rate mortgages. Most people choose a 5-year fixed rate or a 5-year variable rate mortgage. There is a strategy where some people do choose a shorter term, but for the most part, the 5-year term is the most popular. What that means is that your rate, if you're in a fixed rate, will stay the same for 5 years, and then after 5 years, it'll be time to decide, okay, geez, now what do I do? Do I go renew for another 5-year term? Do I renew for a 1-year term? Do I choose a fixed rate? Do I choose a variable rate? You're not going to have to make that decision until 5 years from now if you choose a 5-year term. And I would be certainly talking to you about the pros and the cons of which way to go. Rates. Well, there are fixed rates and there are variable rates, and there are open mortgages and there are closed mortgages. Rates vary depending on all kinds of things. So it depends on how long the rate needs to be held for. So it might be a quick close where you're going to be purchasing the house within 30 days or 45 days or 60 days. It could be that it's an insured mortgage or that it's a conventional mortgage. It could be that your down payment is from your own resources or your down payment is from gifted resources. So there are various different factors that determine what rates you are eligible for. Another one is that some of the low rates that are being advertised, they can come with a much larger penalty. And we'll talk about penalties in a moment. With the variable rate mortgages, you can lock in to a fixed rate at any time. You can also set your payments so that they're much higher than the actual rate, and that also has an effect on lowering your amortization. And you can, or you can use a strategy of that you want your payment to be as low as possible. So that's a little bit about the fixed rates and the variable rates. Should I use a mortgage broker? Well, the reason why you should use a mortgage broker is because we have access to all of the banks and all of the lenders with the odd exception. So chances are that whatever bank you bank with, I may very well be able to send your mortgage application to that bank and quite possibly get you a better rate than if you were to just walk into that branch. The other thing is that that's all I do is mortgage financing. So I'm typically, for a mortgage broker, mortgage agent, all they do is mortgage financing. So it's a specialty. Just like you specialize in what you do at your job, I specialize in mortgage financing. The other thing is that the cost, there is no cost to you. It's a free service. And what I mean by that is that as long as you qualify for a lending, so if I were to put your mortgage through any of the many banks or any of the many lenders, as opposed to the subprime lending, which would be typically because of credit concerns. But as long as we're able to put you through the regular banks, then there's no cost for the services, as I'm paid by the lender at the time of funding. The other thing is that I work for you on your terms. So if you want to come in and meet me face to face, we can do that. If you would rather that we communicate by phone or by email, then not a problem. If you want to meet in the evenings or on the weekend, then that's okay too. So whatever works best for you is absolutely fine for me. My hours are around what works for you. The application process is very quick and easy. Typically, if you were going to go to your bank, then you'd have to set up an appointment that's convenient for you and convenient for the two of you to go in and sit down and go through the application process. I can take an application with you over the telephone. It takes us about 5 to 10 minutes over the phone, or I can send you an email that has a mortgage application attached. So it's a quick and simple process to get it done. I can also take a look at your credit bureau, and I don't have to pull it I only have to look at it just the one time. Whereas if you were to go from bank to bank, as an example, you would have multiple pulls on your credit bureau, and that can have an effect on your credit, which may have a detrimental effect. Costs. So what are the costs for getting a mortgage? Well, nothing's hidden. There's no hidden costs. So I give you a down payment calculation sheet. I give you a closing cost sheet so that you know exactly what's happening with all of the money. Because my job is to make you feel confident and comfortable with the whole process. And the more you know, the more confident you're going to be in the process. So with costs, you do need to have 1.5% of the purchase price for your closing costs. Now, closing costs would be, let's say you're putting less than 20% down and the mortgage therefore needs to be insured. Well, that insurance premium is added onto the mortgage. However, you do have to pay the 8% PST on that insurance premium, and that becomes one of your closing costs. The other closing costs would be what your lawyer charges you, and if you're buying for the first time, it's just a one-sided transaction, so you're just purchasing. So typically the lawyer is going to be about $1,500, between say $1,300 and $1,500 right now, and that is for their legal fees and their disbursements. Now, part of their disbursements is what's called land title insurance, and land title insurance is a type of insurance that basically protects you from various things to do with the title of your property. So in the lawyer's costs and the disbursements, land title insurance is part of that. The other cost would be land transfer tax. Now, as a first-time home buyer, you are exempt, as I mentioned, for the first $2,000 of land transfer tax. However, if there is, if it's higher than $2,000, then you would have to have the difference. You can Google land transfer tax and a calculator comes up right away. It's about 1% of your purchase price. It may be a little bit more than 1% depending on the purchase price. So if you Google that, you'll see exactly what your land transfer tax would be. So those are really your closing costs. Is your PST, your legal fees with the disbursements, including the land title insurance, and your land transfer tax. The only other thing, it's not really a cost, but it would be a property tax adjustment. And let's say you are buying on December the 15th, but you're closing, so that's your closing, you're moving in December 15th, and the people that own the house right now, they've paid their property taxes until December 31st. You would be reimbursing that person for their property taxes for those 16 days. But that's something that the lawyer looks after, not something that you need to worry about. One other thing is that when you go to get your hydro set up, the hydro company often asks for a deposit. Now, sometimes they say if you can show us a credit bureau that shows that you have good credit, that then you don't have to put this $250 deposit down. You can just ask me for a copy of your credit bureau, and I can send that to you to save you that expense. Well, the next step is that if you don't have a real estate agent, then it would be a matter of getting a real estate agent, and I can certainly refer a realtor to you for the area that you're wanting to purchase in. The realtor definitely will want to know that you're pre-approved, and it's important for you to know that you're pre-approved as well before you go out and start looking, because if you decide that you're going to put an offer in, then your offer is going to be, and your offer is accepted, then you feel comfortable and confident that you're going to be able to get a mortgage for that property. Also, if I've done a full pre-approval on you and I've collected in your proof of income documentation and I've said, okay, you are good to go, all thumbs up, then I'm in a position to say to you, you can go in without the condition of financing, because you can often go into competition when you put an offer in on a house. And if your offer is able to say that you don't need a condition of financing, chances of you winning that house over somebody else who has that condition in is pretty high. So getting a full pre-approval is definitely in your best interest. Get pre-approved today. I'd be more than happy to chat with you. Just put your name and email address and phone number in below, and I'd be happy to give you a shout and answer all of your questions, gather some information, get you pre-approved right away. Looking forward to talking to you. Good luck.